which comes up in minds of non-residents who have got quite exposure of financial assets and investments in India is that, are there any ways and means by which somebody can lawfully plan their tax affairs in India? Yes, very much. One can plan tax affairs lawfully in India. And here are certain different ways by which one can legitimately reduce their tax liability by making some lawful planning. There are certain deductions under section 80C, 80D, 80G. 80C is for certain investment, 80D is for some health insurance, 80G is for donation, and the deduction under section 80TTA is for the interest which is received on the NRO account for a certain amount of money. Then if NRI has bought any property in India by availing any loan, the interest amount on those loans is also deductible within a certain frame of deductions. Then this is something, now this planning is something which is quite very much important. If an NRI is intending to stay in India for a long period of time, then ideally they can and they should plan their their stay in India in the manner that their stay is split across 2 financial years. So when it comes to the way Income Tax Act calculates the number of days of stay in India is on the basis of 1st of April to 31st of March, which is the financial year in India, and the number of days of stay on which is on in that particular financial year. So if one wants to stay for a longish period of time, one can split their stay across 2 financial years and thereby avoid being a tax resident of India and continue enjoying the non-resident status. Say when there is any incidence of capital gain, then there are certain deductions from the capital gains, and those deductions can be availed by investing in bonds, investing in residential houses, and the deductions are available on the basis of the investment which is made and on the basis of the capital gains which is accruing or arising on the transaction of that capital gain. Say gifts from one person to another in India between relatives which have been specified out in the slide is completely tax-free to any amount. So one can make a simple planning by which, say, I want to reduce my tax liability in India on account of the incomes which I generate out of my investments in India. So what I can simply do is that I can gift a certain amount of money to my son who would receive that gift, and because of the relationship between father and son, which is a defined relationship under section 56(2), the transaction does not attract any taxation, and that capital which is received or gift which is received by my son would help him generate his own income by which tax planning is possible. Then planning can be done to manage the tax affairs by virtue of by executing a will, and amounts received by virtue of inheritance or under a will are completely tax-free, and amounts received on the occasion of marriage are also completely tax-free. Say remitting money to India is completely tax-free. So if there is a remittance received from outside of India in my account, if I am an NRI, then they are completely tax-free. But if there is an income which is directly received in my account from outside of India, then that income which comes to India directly, otherwise than by way of remittance, becomes taxable in India. So the ideal planning is that one should receive those monies outside India in those accounts which are held outside India, and then bring those monies to India by way of a remittance. Then all these deductions which we have been discussing and talking, which is interest on NRE accounts, or maybe on maturity of insurance policies, or capital gain exemptions. But all these incomes which are exempted or deductible in India are limited to the Indian law, and they could be taxable in the country of residence in which the NRI is based. Another planning which can be done is that if there is an interest income from an NRO account, which is a taxable account, the balances of the NRO account can be transferred to NRE account or FCNR account, which are tax-free accounts. India allows a creation of an entity under the Income Tax Act, which is a separate legal entity, which is a Hindu undivided family entity, which can be used as a means of planning the tax affairs in India in a legitimate and